Chana obviously believes it is so, which is why they're launching this. Let's get in Prableen Bajpai. Now, she's been with us on a couple of shows, and you guys have loved what she said and she's advised. So let's ask her what she makes of it. Prableen, good having you. Thanks for joining in, and thanks for being by patiently. Just off the bat, straight away, Prableen, would you reckon, as an advisor who tells people where they should park their money, so to say, or even manages money for them, maybe, would you choose flexi cap funds at the current juncture?
Good afternoon, Niraj. Absolutely. I think FlexiCap funds definitely, as Rajat said, it does make part of the core portfolio for any investor. But if that core has to be filled by an NFO, I think at this point, that's the question. I think there's a huge amount of variety out there in the FlexiCap space. And investors who do not have a FlexiCap fund, I believe that a lot of investors who've been investing 2 or 3 years or more would definitely have a FlexiCap fund already in their portfolios. And if they don't, then we do have a huge range of 35 to 40 good FlexiCap funds out there, and it definitely should be a part of the core portfolio, even at this juncture.
Probably is interesting. Most times when I speak to advisors and experts on the mutual fund subject, they say that why do you want to go for an NFO? You can go for a tried and tested product. And yet, of course, fund houses do come out with NFOs because there has to be, if they don't have a product in their portfolio, they will launch it. So therefore, would you believe that for an NFO to do well, or for people to actually subscribe to an NFO, it might be helpful to wait and see how the fund does for a period of, say, 3 to 6 months to 1 year or whatever it is, and then put in the money if that category is well discovered?
Absolutely, Neeraj. I'll give a analogy here. It's like you're going for reading the credentials. We are just going by any NFO which comes. It sounds very impressive. This is already a very, very well established category because it was the multi cap, which is now the flexi cap. So why not give it a chance? There is no need to rush to go and kind of buy a ICICI Prudential flexi cap at this stage. Even for an investor who's looking to probably go and invest in this fund, I definitely feel that some amount of time can be given before you pick the fund. I personally believe that the performance during market downturns, that is a big testing time. And it's good to go in for a fund where you've seen how the fund performs during drawdowns.
What are some of these funds, Prableen, if you're at liberty to tell us? Maybe a few names which have done well in the drawdown, or you believe are good flexi-cap fund options anyway, choice?
Okay, so I'll give you 2 names here, Niraj, and just a disclaimer that it's just a suggestion and investors must use their own due diligence. One of them would be, of course, I think you're talking about FlexiCap, so you can't go without naming Parag Parikh. The first reason being that it has a beta of just about 0.74. So it's going to go maybe not as high as the markets go up, but then during drawdowns, there is limited downside to it as well. And it was proved even during the fall of March 2020. The fund was down just by about 30%, while the broader category was down by about 37 to 38%. And the turnover ratio, despite the fact that the category actually offers a lot of flexibility, they have very about 7%. So it's not very dynamically managed, but it also means that probably the stocks that they pick, they are high conviction stocks and they are sticking to them even during times when, situation may not be that great. A little concern here, the size of the fund has definitely grown a little bigger. It's about 10,000 crore. But I think the space is such because you can move quite freely. Shouldn't be a concern also because they have a global allocation. And the second name, I think can be Canara Robeco here. Again, it's a 4,000 crore fund. So agile, not too huge. And again, beta of about 0.85, much lesser than 1. And I think this again, it's a good stock selection based approach here. This can also be considered. A few other names, PGIM has done very well recently. But again, I think some more time can be given before investors, jump on to buying that product.
Okay, fair call. Thanks for that, Prableen. Now, the other two things that we want to talk to you about, Prableen. One is, of course, equal weighted passive strategies. Now, uh, I think people have limited understanding of equal weighted indices. People have very limited understanding of passive strategies, and therefore, it'll be lovely to hear from you uh, the importance of having or not having equal weighted passive strategies in one's portfolio, and what should investors, how do I say, hope or expect when they invest into these into this category, so to say.
So, Neeraj, of course, passive investing is broadly that you're tracking an index, and the most popular indices, whether it is India or globally, are indices like S&P 500 or Nasdaq 100, Nasdaq Composite, or in India Nifty 50 and BSE Sensex. Now, all these are market-weighted indices. As in, as the price goes up of a stock multiplied by the number of shares which are there in the market cap goes up, and so does the weightage. An equal weighted strategy just follows the parent in terms of the constituents. So a Nifty 50 equal will have all the constituents which the regular Nifty 50 index has, but it has a capping on the maximum weightage that it's going to give to a stock, and it's equal weighted. So 50 stocks, so 100 divided by 50, it would be a 2% allocation. If you're talking about Nifty 100, Neeraj, then it would be a 1% allocation to each stock. And for investors in India, there is Nifty 50 equal and Nifty 100 equal. These are the two strategies which are available for them. And to take exposure outside India, the NYSE, New York Stock Exchange, FANG Class is one index, which is again the equal weighted strategy. And the advantage here, Neeraj, which I personally feel, is that currently I think most of us are holding a lot of active funds in our portfolios. And any active fund, whether it is from the mid-cap space, the multi-cap, the flexi-cap space, will always have a proportion. Even if you're not holding a large cap, you'll always have a proportion of large cap stocks in your portfolio, because the fund has to maintain that amount of liquidity. And I think it goes without saying that HDFCs, ICICI, Infosys, Reliance will be a part of it. So when you're going with the regular index fund, I feel the overall concentration of a investor's portfolio, gets skewed towards these couple of stocks. A regular Nifty 50 has 68% weightage in the top 10 stocks. And equal weightage just brings you to 20% weightage. So I feel it reduces your overall concentration risk, makes it a more diversified in terms of holding an index. And even if you look at the performance, there have been years where there's huge polarization. So a Nifty 50 regular would outperform, but then there have been years, if you're looking from 2000 till about 2021, over these years, 12 out of 21 years, Nifty 50 equal has outperformed if you're looking at calendar years. And even in terms of rolling returns, there have been phases where the Nifty 50 equal has outperformed, during phases it has underperformed. So I feel during times of broader market rally, equal weighted strategy is definitely good. And also from the point of view that most of us as Indians would have a combination of active and passive funds.
Yeah, which is very important. So what are the options available, and can you pick I'm not saying it's a favorite, but can you give an advice of the one name out of the 4 or 5 options available?
Right. So within India, Neeraj, currently, if one has to track Nifty 50 equal index, then we have the DSP fund, which was launched in 2017. And very recently, ABSL closed their NFO, which is also a equal weighted strategy. So we have 2 funds here. And for tracking the Nifty 100, there are 2 funds again, one by Sundaram and one by Principal. Considering that they are undergoing this merger and they would be a single entity, I would say that investors at this point should avoid that strategy, going with either of the funds, because probably eventually they would merge the 2, or just continue with one of them. So probably let things settle and then they can go for it. So out of these four, I feel DSP Nifty 50 equal is a good bet. Because it helps you reduce your sectoral allocations right from 37%, which is in Nifty regular 50, it comes down to about 21%. So overall sector weightage gets more diluted, and I feel it's a good way of tracking the top 50 stocks, because there is also that automated kind of rebalancing, Neeraj, here. It's a good mix of, let's say, the growth and value strategy, which we often talk about. Because the overvalued stocks during the quarterly rebalancing will be sold, there will be profit booking, and then the stocks which haven't, performed that well, they would be bought. So I feel it's a good amalgamation of these two strategies as well, and better suited in combination with active fund portfolio. And I feel DSP Nifty 50 equal is a fund I think investors can look at.
Yeah. So Prableen, thank you for that, and thanks for explaining in detail as to why people should use these equal weighted passive strategies as well.
Yeah,
diversification of all forms. Yeah, sorry, please finish.
Neeraj, I'd like to add here that when we're talking about an equal weighted strategy, I mentioned the Mirai New York Stock Exchange FANG Plus, which is again an equal weighted strategy. But investors should be very careful that in that fund, although these funds, because they have a larger portfolio, 50 stocks and 100 stocks, the concentration risk actually reduces by going and taking the equal weighted strategy in that particular fund, because only 10 constituents are there. The concentration risk actually increases. So they must be careful about that if they are looking at investing in that particular fund.
Yeah, that's a pertinent point as well. Okay, so viewers, take your picks very, very wisely. But since so many people told me, including people from my office as well, and that if you want to start off investing in funds, how should we approach? What are the kind of categories that should we have? And try and make it simple and not too complicated. Prableen, can you, in a nutshell, tell the viewer who's listening in right now, or will of course listen later on, or read about it, as to how should she or he approach his first mutual fund basket?
So I feel if you're talking about equities, Neeraj, if the horizon is long, more than 5 years to 10, 15 years, I think the first fund an investor should pick is an index fund. And for them, it doesn't matter whether they're going for an equal weighted strategy or a regular fund, because they would not have any other active funds as it is in the portfolio. So either ways, it's okay. So a passive fund tracking the large cap space. Second, I feel that a flexi cap fund again can make your core basket. So within the actively managed space, I feel a flexi cap fund, and it can be complemented with an international fund providing international exposure with a capping of about 15 to 20%, depending on what's the objective of that investment. And of course, these decisions have to be based on the risk appetite and goals and other details. But broadly, I feel these are the three funds they can start off with if it's a long-term portfolio. If it's for a lesser time period, let's say about 5 years, and the risk appetite is high, they can do an SIP, take exposure in tranches, again into an index fund, and probably that can be complemented by an hybrid aggressive fund or a balanced advantage category fund for that 5-year kind of a period, but only if the risk horizon is decent enough.
So you're saying a balanced advantage fund, according to you, would carry a higher risk profile as opposed to a flexi cap?
No, not at all. A flexi cap will definitely have a higher risk. Okay. So for a 5-year period, I'm saying that a simple index fund again, and it can be complemented with a hybrid or a balanced advantage kind of fund where you do have a bit of debt allocation. And generally for a first-time investor, again, Niraj, that I feel an SIP for debt fund is also really great, because it helps you to build a bit of contingency fund, or let's say a fund which can also give you the feel-good factor. During a drawdown, you as a new investor, it's easy to say that I'm okay with the 30% fall. It is not very easy to kind of digest that kind of a fall. So I feel a small exposure in a debt fund can provide that kind of a buffer if you're not going in for a hybrid kind of fund. And for a 3-year period, a conservative hybrid category can be considered for a medium, person with a moderate risk appetite. Because equities are not something that ideally we should be touching for a period for less than 5 years. So there I feel maybe a 15 to 20% exposure through the conservative hybrid category can be taken if the person's risk appetite matches.
Fair call. Probably this was lovely. We could, of course, continue the conversation and I could ask you about the various schemes within all of these as well, but maybe leave that for another show. For now, this was lovely. Thank you so much for taking the time out and speaking to us and for your candid opinion.
Thank you.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.